So one of the things
True.
that I'm teaching all the different brokers, not just here in South Florida, but in other locations, is to look at the relative adjustment that you would make, whether you're in an urban area or a suburban area, or you're in Florida or Georgia, right? And so you have a lot of variability even within a range.
I'm living in Wynwood, breathing in it since I moved down here full time. It's an interesting neighborhood, right? And I'm sure this has happened before, but in terms of the amount of buildings that flew up that quickly, mostly mixed use, where you see the residentials filling up, a lot of the retail just isn't yet because there's not enough people here to support it, and the rents are asking an insane amount, and a lot of it is cold shell as well. So it's a mix of what you were just talking about. Interest rates also went up right after some of these projects started construction, and in Society Wynwood's case, right, where I had lived, they sold the retail and the liquidity stretch didn't make any sense. They sold the retail as condo. They wanted to hold on to the building. And it's just an interesting landscape where I'm curious to see how it plays out, because it is really high rent. I saw recently some of the most recent builds right in the heart of Wynwood are asking close to $120 a square foot, which I didn't even know was possible when I'm going to school in Buffalo and retail rent is $20 maybe.
Yeah. For downtown.
Yeah.
What's even crazier is that in 2017, when I was here in Miami, I'm working on projects like this and looking at different opportunities. I was getting calls from some of the people who own the retail, and they were saying that they were going to charge $120 a square foot. And I was in the situation of saying, there's no way that I'm going to underwrite $120 per square foot. This was before they even really changed the zoning, right? Everybody was talking about it. There was already so much activity and speculation in Wynwood, and some of the people were charging 120 and getting it at that time. The supply was so much more limited, but it was just an unsustainable situation back then.
Especially when there's no people above, there's no real residential density to support that retail, right? Because at that point in time, there's no big building, so everyone was traveling to that retail, right, rather than living in the retail.
There were no offices. I mean, there were some creative offices or like the art galleries and whatnot.
Yeah.
But people had to come to Wynwood and want to be there. But it was really art galleries, restaurants, bars, sneaker stores, things like that. And now I would say it's much more justified than it was back then, but it's still a stretch. And for certain types of tenants, it's never going to be achievable, because how much does a haircut cost? How many chairs can you fit into a barbershop or a salon? How many people, even if you fill it up to the max, right? There's a threshold that is the maximum amount of revenue that can be generated from a number of seats in a barbershop, a salon, a restaurant, whatever it is. And to have a property where you're not going to have a lot of turnover in your tenant base, the 120 is just not an achievable number in a lot of situations, unless you have a special tenant.
Yeah, unless you have a Michelin star restaurant or a very upscale restaurant that has the clientele that will come back all the time, which in many cases I see, again, living, breathing in Wynwood, a lot of people filling these brand new buildings love it. In some cases, 2 to 3 month free rent concessions, but it's young professionals, right? And yeah, of course, everyone wants to go out, have a good time, but you can't just spend all this money on $20 drinks. And that's what a lot of these establishments are doing. They're driving revenue through drinks or by increasing some of their food. And that's another big piece of inflation that I feel being in Wynwood. And I know that's a whole thing throughout Miami, right? Because there's so much development and it's so new. And the only way that some of the developers can make it make sense, or some of the owners make it make sense, is to increase rent. And then it falls onto the tenants, and then it falls onto the people living there.
For me, what I have seen happen, and we only see this in development, other people don't see this, is that they would never even have any idea that this is the case, but it starts in South Florida, at least, or Florida generally. We don't have income tax. So how do the municipalities get money to survive or to provide infrastructure and improvements and things? They shift that cost at the very beginning to developers, right? So the residents, the general public, sees their property taxes, right? Yeah. That's like the big tax that everybody has in their mind is property taxes. But in Florida, we have homestead exemptions. So if you're living in your own place, your property taxes are not even necessarily going up with the market. So that property tax burden gets shifted onto commercial properties and to investors in residential properties. And then it also gets shifted into impact fees and additional costs at the front end for developers. So developers have a huge upfront cost that they're obligated to, that
with the more expensive dollars
that come out earlier, that are coming from the sponsor.
More expensive in regards to the equity dollars coming before the debt dollars.
More expensive in the time as well, because it's the first money in, so it's sitting there for a long time.
Yeah.
And so to get financing from a bank and to move the project forward with the whole capital stack that we've talked about, you run into a situation where they have to take those upfront costs and they have to plug it into your entire project pro forma, that then increases the burden on the tenants, that then turns into an increased cost for the general public again. So it's really just about the hidden cost of the capital stack, if you will.
Yeah.
And all starting with the early planning stages of the project and the development expenses, whether you call them a tax or you call them a fee or whatever, those are things that all get pushed through the system.
And you would hope, or I'm just remembering this, the mayor went on with Omar Morales recently, and he was mentioning how there's a ton of construction, a lot of it's luxury condo, but in many cases it's people's second, third home, and they're, in other cases, putting their money here because it's not as safe maybe in their home country. It's a little bit more of a stable investment. So you would hope that those property taxes somewhat supplement the issue that you were just talking about. But we worked in New Mexico and Texas. Was it Texas that had the super high taxes?
Yeah. So New Mexico has a different problem, or a different issue for developers, is that they have a tax on like everything. Yeah. And so when you think that your construction cost is $1 million, you have to add 10%.
That's what it was. Yeah. So it's not property taxes. Well, it's a flat.
Theirs is a percentage of the dollars that are spent. So everything that you do in New Mexico just is more expensive. Mm-hmm. And then in Texas, they have really high property taxes, just like here. So on a multifamily project, the rule of thumb that I use is 40% of your revenue should be whatever your operating expenses are, and on a multifamily project in South Florida, in large part because of insurance and taxes. In Texas, had to start using 50%. They don't have as much of an insurance burden, but they do have the really high tax issues. So different municipalities, you're going to run into all kinds of different underwriting constraints that you're having to deal with.
Yeah. And should be underwriting at a 6+ cap. None of that. Maybe a 5 cap if you have the best piece of land of all time. But there's so much uncertainty in the way things have moved, and now the new normal is this new interest rate. I don't even want to call it high anymore because it's just what it is. And that's where, when people are complaining about it at this point, it's the new reality of things.
But for the cap rates, our situation and the way that we're underwriting and looking at deals in our markets and for our property types, it's maybe different than other places. So one of the things that I'm teaching all the different brokers, not just here in South Florida, but in other locations, is to look at the relative adjustment that you would make, whether you're in an urban area or a suburban area, or you're in Florida or Georgia, right? And so you have a lot of variability even within a range. And the cap rates are affected by the interest rates, and it matters, but it's not the determining factor. And a lot of people, if they were just academically looking at it, they would have said that South Florida at this point, everything would be selling at a 7 cap, right? And you can probably look back on LinkedIn and find a lot of people who were making predictions of what the sales prices were going to be today. And they've been making that same prediction since 2022. And it's okay, a broken clock. It's going to be right twice in a day.
Yeah.
And so eventually those people will be right with whatever a price or a cap rate expectation is. But if you really look at the data right now, and that's, again, right now, not a development project, but right now, things in Class A urban properties in South Florida are still selling for 5s because of that incredible demand that we have that's sustained us in an abnormal way when you're comparing it to the rest of the country.
And not to go to financial talk, but it's bonds alike, right? It makes sense why I would trade at a 5 cap when it's 100 plus units, it's give or take 5% vacancy. That large amount of units gives some type of diversity to that one asset. And just at that given time, it's not like rents are really going to come down. These huge companies are coming here. The form of buildings charging the most in our area, right, being the Wynwood Arts and Entertainment Edgewater area, and it's filling up faster than anyone could have imagined, or at least from what I hear, that's where everyone wants to be, is the form of building, and they're charging close to $5.50 a foot, driven by the Whole Foods. But
yeah, that's what I would say, is that it's really about the retail demand that can be created. And just like the Lifetime project with the Trader Joe's, we knew that there was incredible demand. And you can look, if you're a data nerd, you can really look and dive into the difference in cap rates for these different types of properties. And you can go and pull comps essentially on a national basis and look at how much value is being derived from having a Whole Foods in your building. And that can determine what rent you might want to you want to offer to Whole Foods to get them or incentivize them to come to your property, or Trader Joe's or whoever else.
And it's by nature a sticky, like it's a sticky piece of retail that's going to keep people there.
Yeah, and it's a long-term lease. Grocery is something that is needed, right? Even though you have things like Instacart or the Whole Foods delivery through Amazon, people still go to the grocery store. And I don't think that's going to be changing anytime soon. If you just want to walk downstairs and get something, that's different than having to walk 5 blocks to get something. And so people who were building in suburbs because there's a shopping center with a Whole Foods, that's going to be very different than if you're just literally living on top of Whole Foods and you make it super easy. Because even here in Edgewater, it's still a driving neighborhood, but there's a lot of pedestrian activity. And if you can avoid getting in the car, then you will. And in particular in high-rise buildings, it's difficult to get a large grocery haul and walk a couple of blocks when it's 90 degrees outside, 90% humidity.
Yeah.
So you have other factors beyond just the grocery aspect to it. You have the proximity, you have the actual building design. And so whether people are thinking about it or not, these are factoring into the real rents that are driving things. And I think for us and the way that we're developing, that's a big part of what our investment thesis is, to be as close as we can be to these retail demand generators.
The lifestyle retail, right?
These things that are sticky, that people actually want to be next to. And again, thinking about our environment, it's not 5 blocks, 10 blocks away and having a zip code. It's about having a really premier site that's as close as possible to these things, because that's how people want to live. And at the same time, we don't have to build the Whole Foods, right? We can build
next to the Whole Foods.
We can build next to the Whole Foods as close as, or not just as close as possible, but building in an optimal location that we know is still walkable, that people can have easy access to the restaurants, to the grocery store, to the cafe, or whatever those drivers are that are really creating demand for residential.